Today we're going to talk about the debt, the deficit and quantitative easing, and how to invest if we should have an inflationary environment. This seminar discusses some of the long-term consequences this country may face if the debt bubble pops. It contains forward-looking statements. It is never possible, however, for anyone to predict the future of the economy. Nevertheless, inflation and other dangers discussed in this seminar are legitimate concerns. The seminar is intended for educational purposes only. The opinions included do not constitute investment advice or a recommendation to buy or sell a security. And, of course, past performance is not a guarantee of future results. What we're going to talk about today is the ever-expanding money supply, the growing national debt, the stock market and the Fed. Are they playing musical chairs? The bond market and rising interest rates, and what to do if you believe high inflation is coming. The Chinese have a symbol for crisis that consists of two separate symbols. One is danger and one is opportunity. This seminar will discuss alarming events which may occur over the next several years. However, it's better to be armed with this knowledge so you can prepare and plan for what is coming. This is a chart showing the Federal Reserve balance sheet, and it goes back to 2008. And the Federal Reserve balance sheet is really another term for the money supply. In 2008, we had $800 billion. Since then, in the next 5+ years, it has grown to $4.1 trillion. That's 5 times what it was in 2008. That's an increase of 400%. Is there any reason to be concerned about that? The Federal Reserve Bank of Minneapolis conducted a study of 110 countries that experienced high inflation between the years 1960 and 1990. Their study concluded that there is a high correlation between the rate of growth of the money supply and the rate of inflation. Their study went on to say that the correlation is very close to linear. So if we've had a 400% increase in the money supply, does that mean we're going to have 400% inflation? It's possible. Alan Greenspan was Fed chairman between 1987 and 2006. So he had Ben Bernanke's job for 19 years. Ben Bernanke had the job for 8 years. A year ago, Alan Greenspan said, we have at this particular stage a fiat money, which is essentially money printed by a government, and it's usually a central bank which is authorized to do so. Some mechanism has got to be in place that restricts the amount of money which is produced, either a gold standard or a currency board, because unless you do that, all of history suggests that inflation will take hold with very deleterious effects on economic activity. Bill Gross co-founded PIMCO, which is one of Orange County's mutual funds, and he manages the world's largest mutual fund, the Total Return Fund. In September 2012, in his Investment Outlook newsletter, which is published monthly by PIMCO, he referred to our monetary system as a shipwreck, for which perhaps we have the Fed and other central banks to blame. He didn't just say this at a cocktail party or in passing, so I'm sure he and his board of directors thought long and hard before they would make a statement that some might consider reckless of calling our money system a shipwreck. Jim Rogers is a very interesting guy. He began in business at the age of 5, picking up pop bottles and selling peanuts at baseball games. In December 2007, he sold his New York home for $16 million and moved to Singapore. Excuse me. So how did he go from peanuts to 16 million? It's pretty interesting. In 1973, he and George Soros started the Quantum Fund. Over the next 10 years, the Quantum Fund had total returns of 4,200%. During the same 10 years, the S&P 500 had returns of 47%. So he did almost 90 times better than the S&P 500. Now, for a money manager over a long period of time to beat the S&P 500 by a little bit, that's pretty good because the S&P 500 doesn't have any expenses. So that money manager had to overcome the drag of the expenses and make better decisions than the S&P on average. For a money manager to double the S&P, that would be pretty astounding. But George Soros, his fund did almost 90 times what the S&P 500 did. So that's really incredible. So he should know something about money and investing. He said, for the first time in recorded history, we have nearly every central bank printing money and trying to debase their currency. This has never happened before. Why would a central bank want to debase their currency? Well, just as China did last week, if a central bank makes their currency weaker by debasing it, then their exports are cheaper for other countries to import. And so it will help their gross national product if they, quote unquote, debase their currency and make it worth less. He went on to say that central planners' policies are punishing the prudent in favor of rescuing the irresponsible. And he also said, history shows that when a country prints massive amounts of money, the aftermath has always had grievous economic, social, and often human costs. David Wiedemer, Robert Wiedemer, and Cindy Spitzer wrote a book, Aftershock. In 2000, that was written in 2011. In 2006, they published a book, America's Bubble Economy, which they had begun writing in 2004. America's Bubble Economy predicted the fall of the real estate market. So 4 years before the event, David, Robert, and Cindy had a pretty good idea that the real estate market was going to collapse. And they were one of the few people that saw that and published that prediction in their 2006 book, America's Bubble Economy. In their most recent book, Aftershock Second Edition, which came out in 2011, they predict that in the next few years, the government will no longer be able to refinance its debt. Its first action will be to make up the difference between spending and the tax revenues it takes in by massively increasing the money supply and creating multi-100% inflation. So if I had just read this quote to you without the other sources from the Federal Reserve Bank of Minneapolis itself and from the former chairman of the Fed, Alan Greenspan, it might seem like it's way out in left field. But it does not seem as ridiculous, and it seems more plausible given the fact that other people who should know about the money supply have said that we may get very high inflation. This is a chart showing the national debt from 1940 to 1923. The data is taken from the Office of Management and Budget website. That's the official forecasting arm of the U.S. government. In December 2013, our national debt was $17.2 trillion. By 2023, they estimate that our national debt will be $25.3 trillion. So a couple of interesting assumptions that are hidden, they're not hidden, but in this chart. are that, number one, we're not going to cut our spending enough that it will affect the national debt. It'll keep growing. We're not going to increase taxes enough to get the national debt under control. And the final one is that we think the public will just keep buying this debt that we say we're not going to repay, because the line never goes down. Recently, Paul Ryan and Patty Murray negotiated the Bipartisan Budget Act of 2013. What that act did is it took the last budget that was done in 2011 under the Budget Control Act, where they limited the Budget Control Act established a joint committee whose job it was to reduce spending over 10 years by $1.2 trillion. If they couldn't do that, sequestration would kick in. Well, the Budget Committee could not reduce spending, so sequestration kicked in, and in 2013, sequestration caused us to spend $85 billion less between March 1st, 2013 and September 30th, 2013. Well, anyway, they took the budget that previous Congress had done, and in order to balance things, they decreased spending over a 10-year period by $23 billion. But to do that, they added to the spending the first 3 years through the 2016 election, and then over the next 5 years, it was cut a little bit. And then in years 9 and 10, it was cut a lot. Now, this is basically a perfect example of kicking the can down the road. And it shows that Congress cannot control or will not control our spending. One of the problems Congress has is that if they suggested serious cuts to Social Security or other welfare benefits, or when they suggest big increases in taxes, they get a lot of pushback. And if they're the only congressman doing this, they will not stand a very good chance of getting reelected. And they realize that the other 534 congressmen are not going to line up behind them if they, for example, want to cut Social Security. This chart shows the interest rate on the 10-year Treasury over the last 55 years. And in 1981, that interest rate hit a peak of 15.84, but over the next 30 years, it was on a downward trend, and it hit a 200-year low on June 1st, 2012. It got down to 1.44%, which is less than one-tenth of what it was back in 1981. That was a 200-year low. Since that time, it has more than doubled. December 31st, it was 3.04%. Recently, I think it's around 2.75 or so percent. One of the key takeaways from this chart is the average rate over this time frame was 6.36%. This graph shows in these left two columns the budget of the U.S. government in percentage terms, with revenues being 100%, the actual budget for 2013. These columns show what that would have looked like if interest rates, instead of the average interest, instead of being 1.8%, was 6.3% on that debt. So in 2013, with our revenues at 100%, our entitlements were 72% of revenues. Entitlements are things like Social Security, Medicare, federal pensions, things that are required to be paid out by law. Interest was 8%, defense spending 27%, and non-defense 16%. So we had to borrow 23% because we didn't have enough to cover all of the expenses. Now, the interest last year was $223 billion on net debt of $12.403 trillion. That worked out to be 1.8%. What is net debt? Well, when money is sent into the Social Security Administration, for example, the Social Security Administration is required to buy U.S. government bonds with that. So there is about $5 trillion out of the 17 trillion national debt that is owed to other U.S. government agencies. If the U.S. government pays interest on that debt, it really doesn't cost anything, because if interest rates go up, the Social Security Administration would get more interest on their debt. But on the net debt, that's owned by the public, both foreigners and residents of the United States. So if they had to pay 6.3% on the 12 trillion of debt, that would have been 781 billion last year. That is 558 billion higher than the 223 that they paid out. I believe that's about an increase of 6.5 times. No, I'm sorry, not 6.5 times. Anyway, it's more than double. So if we had a problem raising 85 billion with sequestration, how would we pay an additional 558 billion? So you can tell that they can't do that. But if the interest would have been 6.3%, our entitlements still would have been 72% of revenues. Our interest would have been 28% of revenues. So all of our revenues would have been consumed by entitlements and interest. We would have had to borrow to cover defense and non-defense spending. So imagine what happens if we go back to the 15% interest, or it's twice what this is. You can see how this could start to snowball, and that added interest on top of our debt would just get out of control. Believe it or not, the national debt is not the 800-pound gorilla in the room. The 800-pound gorilla in the room is the present value of the entitlements. The present value of the entitlements is $60 trillion. And again, the entitlements include Social Security, Medicare, things like that. If you add the national debt to the entitlements, that's $77 trillion. That exceeds the world's product. The gross world product is less than 77 trillion, something like 73 trillion or so. It is 27 times our revenues. I'm sorry, 28 times our revenues of 2.7 trillion, which is irrelevant because we're not using any of those revenues to pay it down anyway. But it just gives you a feeling for the size of the debt of the country. If the country were a corporation, then this debt, this entitlement, would be the equivalent of a defined pension plan, which corporations are required to put on their balance sheet as a liability. The government, using government accounting standards, does not have to put that on their balance sheet as a liability. There's an interesting website called usdebtclock.org. If you go to this website, which I did on January 9, it'll show you the national debt. Here it says it is 17.3 trillion. And then at the bottom, it also shows you U.S. unfunded liabilities. Well, these unfunded liabilities are the entitlements that we've been talking about. So the total unfunded liabilities are 127 trillion. That discounts back to 60 trillion present value. So the concept present value can be explained if a person were to buy a $400,000 house, for example, which I don't know if you can get any more of those in California, but let's say they did, and they put down 25%, their mortgage would be $300,000. With interest over the life of that mortgage, they might pay back $600,000 or $700,000 in total payments. So this 127,000 trillion here is the total future payments for the unfunded liabilities. When you discount that back with an interest factor, it comes back to the $60 trillion we were talking about on the previous slide. I was pretty surprised to find out that Social Security is only 13% of that number. I've always thought that Social Security would be a much larger problem compared, for example, to the prescription drug program or the Medicare liability. It's not so. Social Security out of these three is actually the smallest, being only 13% of this number. The prescription drug program is a greater liability than Social Security. That surprised me quite a bit, that that drug program could exceed the Social Security problem. And then it just really blew me away that Medicare is 70% of that liability. If you go back and look at the previous chart, if Medicare is 70% of that, that means that Medicare represents $42 trillion, which is more than 2.5 times, or about 2.5 times what our national debt is, just for future Medicare expenses. To shift gears, this chart shows the S&P 500 index from January 1st, 1996, when it was 741. It grew over the next 3.25 years. It more than doubled to 1527 on March 24th, 2000. Then we had the dot-com bubble. Over the next 2.5 years, the S&P 500 lost about half of its value, and some 6 years after December 31st, 96, it was back down around the same point at 777, which was 30 points higher than where it was 6 years earlier. Then, over the next 5 years, it doubled again, ending up at 1565 October 9th, 2007, which was 40 higher than it was some 7.5 years earlier on March of 2000. Then we had the collapse of the real estate market and the financial markets, and it lost 57% of its value over a 17-month period, ending up at 677 on March 9th, 2009, which was 100 lower than it was in 2002, some 6.5 years earlier, and lower than it was in 1996, some 12 years earlier. Then it has grown since March 9th up until December 31st, 2013, which is about 3.75 years. We are right now 4 years after this March 9th, 2009. It grew to 1848 at December 31st, 2013, and recently it has hit highs higher than that. In the last week, it has hit all-time highs. So, is there any pattern here? Well, it's pretty clear that it goes through cycles. And what is coming next? Do you think it'll grow another 173%, or do you think maybe we are in for an adjustment? Well, back in 2007, the markets were trading on fundamentals, and the values made sense. In 2007, before the drop in the markets, we had no financial crisis, the economy was booming, housing prices were intact, unemployment was below 5%, and consumers were borrowing and spending. Today, the markets aren't based on fundamentals. The markets primarily are playing musical chairs with the Fed. If the markets hear good news, sometimes they'll go down because they think that may mean an end of quantitative easing. And on the other hand, if the markets hear bad news, they think that the Fed will keep printing money and they want to get some more of that benefit. So today, the markets aren't based on fundamentals. The fundamentals are that durable goods orders are down. Recently, in the last couple of months, housing sales are down, personal income is down, official unemployment is 6.7%. That's as of January. It's a little lower today. But actual unemployment is much higher. If you add back discouraged workers, actual unemployment is in excess of 10%. So the markets today are not supported by fundamentals like production. They appear to be playing musical chairs with the Fed. I recently read on a Bloomberg article that there was an investment committee member who said being in the markets today is like picking up pennies in front of a steamroller. So you can draw your own conclusions on that one. This chart shows interest rates, and when interest rates go up, bond prices go down. This is a graph showing the increase in the interest rate on the 10-year Treasury between May 1st, 2013 and August 31st, 2013. It increased from 1.7% to 2.8%, which was a 65% increase. The long-term government bond index during the same period, and by long-term they mean bonds 10 years or more, went from 25.6 down to 24.5, which is a reduction of 4%. So the point to get out of this graph is that when interest rates go up, bond values go down. As you can see from the chart we looked at a few slides back, showing that interest rates have gone down for 30 plus years, and now they're headed back up. So most people believe interest rates will continue to rise. This chart shows you how much you gain or lose when the interest rates change by 1%. A 1% rise or fall in the interest rates on a 10-year Treasury, an increase would cause the Treasury to lose 9%. A reduction would cause the Treasury to gain 9%. And the longer you are out, a 30-year Treasury would lose over 18% of its value if rates went up 1%, or gain 18% if rates fell 1%. The Fed has said that it will, Janet Yellen in her testimony to Congress said that the Fed will be done with quantitative easing by the end of the year. At the pace they're going of a 10 billion reduction every month, they would be done by the end of summer. Now this chart shows the amount of treasuries the Fed bought in the fourth quarter of 2013 versus the dark blue is the amount of treasuries the public bought in the fourth quarter of 2013. In 2013, the Fed bought $540 billion of treasuries. That represented 80% of the $680 billion deficit. So when the Fed leaves this market, other investors, principally U.S. investors, will have to step forward to buy these treasuries. And the study shown here shows that they would have to buy 5 times the treasuries they bought in 2013 in the future to make up for the void that the Fed will create. What would cause investors to buy 5 times the amount of treasuries? Investors would do that if the interest rates were higher. But the Fed can't let the interest rates get a lot higher, or that will derail the economy, the recovery, the economic recovery. So the Fed is likely not to finish up with tapering. They are much more likely to begin printing a lot more money by year end. The authors of the book Aftershock, as I quoted earlier, said that they will be printing much more money. An author named Michael Pinto believes that by the end of 2014, the Fed will be printing $100 billion a month, could be printing $100 billion a month or more of money. In the book Aftershock, they say that inflation will creep up over time, and it will become increasingly apparent to some investors that we may have a problem. More investors will become skittish about the dollar, and gold will go higher. Panic will come once inflation passes 10% and will grow rapidly. Finally, the government can bail out the housing market and the financial system, but the government can't bail itself out. They also predict in Aftershock, besides having multi-100% inflation, they predict that cuts in military spending will be much larger than contemplated today. Social Security will become means tested, making Social Security essentially a welfare program. Tax rates on the average working individual could rise as high as 50%, and unemployment will be much higher, likely in the 40 to 60% range when counting discouraged employment. If unemployment's in the 40 to 60% range, GDP would drop by a similar amount. And if GDP dropped 50%, for example, half the businesses in the United States would close their doors. Stocks, bonds, and real estate will plunge in value. There are some occupations that will be less affected than others. Teachers, doctors who are general practitioners, nurses, medical administrators, and necessity and sector employees will be affected less. Necessity sector employees are those employees in education, healthcare, utilities, basic food, basic clothing, and government services. Some occupations will benefit. Bankruptcy attorneys, bless their little hearts, will do just fine. Liquidation and auction houses will do well. Those who buy, manage, and resell distressed businesses will do well. Accountants and financial analysts involved in forensic accounting, which is court accounting, and distressed properties will do well. Consultants, bankers, managers, and others involved in acquiring, restructuring, and managing distressed businesses will do well. What do they recommend doing in the book Aftershock? That is, what do they recommend doing for avoiding losses? Well, first you want to pay off your credit cards and your revolving debt, but you don't want to pay off so much that you leave yourself with little savings. You don't want to pay back fixed-rate mortgages and other fixed-rate debt, because you'll be able to pay that back with pennies on the dollar when inflation takes off. They suggest reducing your spending, not next month, but now. Don't retire. Hang on to your job. Get ready to exit stocks. Now, this book was written in 2011, and they said that these events would start to unfold in 2013 to 2015. So we are very close to when this is going to begin. And so I say now exit stocks, because this advice is 2 years old. Avoid real estate until after the bubble pops. Avoid long-term bonds and fixed-rate investments, and avoid whole life insurance and annuities. Investments which historically have done well during an inflationary environment, are precious metals such as gold, platinum, and silver, gold mining stocks, funds that short stocks, funds that short bonds, and foreign currency. Well, what's a fund that shorts stocks, or what is it to short stocks? When you short sell a stock, your broker will loan the stock to you. They take it out of their inventory or from another customer, or borrow it from another brokerage firm. So you can borrow the stock from your broker and sell it in a brokerage firm. The proceeds are credited to your account. Sooner or later, you must close the short sale by buying back the same number of shares and returning them to your broker. If the price drops, you can buy back the stock at a lower price and make a profit on the difference. So if you think the markets are going to drop, you can use a fund, for example, that short stocks, and when the market drops, you will make money on that fund. On the other hand, if prices go up, you have to buy the stock back at a higher price and you lose money. Because you don't own the short stock you're selling, you have to pay the lender any dividends that are declared on the stock during the period you borrow it. But these, in essence, are the 5 major investments they suggest in the book Aftershock. What we're going through is not cyclical by any means. Barter, we first had barter when we were trading, and then people exchanged goods for shells. In the time of Caesar, people exchanged goods for metal money based on gold and silver. In the 1970s, after printing presses were invented, banks printed banknotes that were backed by gold. In 1914, the Federal Reserve was created. At that time, every $35 was backed with 1 ounce of gold. In 1932, FDR made it illegal to own gold. The stated reason for that was that hard times had caused the hoarding of gold, the stalling of economic growth, and made the Depression worse. So FDR made it illegal for citizens to own gold. It was a crime, and they required citizens to turn in their gold. Not everybody did. Some people shipped their gold overseas, but a lot of people did turn in their gold in. On August 15th, 1973, Richard Nixon took us off the gold standard. Now, why did Richard Nixon take us off the gold standard? Well, at that point, we had had the Vietnam War, and the Vietnam War was not funded with income taxes. U.S. citizens could not own gold, but foreigners could own gold. And the price of gold overseas, because so much more money had been created to fund the Vietnam War, the price of gold overseas was much higher than $35 an ounce. So foreigners would bring their dollars to Fort Knox, and the gold was leaving Fort Knox in the boatload. In order to keep Fort Knox from being drained of all its gold, Richard Nixon took us off the gold standard August 15, 1973. Since that time, we've basically had a fiat currency, which means money that is backed only by the full faith and credit of the government. Fiat currency has allowed Republicans to have wars that were not paid for with income taxes, and Democrats to have social programs that were not paid for with income taxes. And both parties, it has allowed them to avoid the hard decisions, as we saw with Paul Ryan and Freddie Murray, to avoid the hard decisions that would get the problem under control. Now, part of the evolution of money, they say in the book Aftershock, will be that we will have these consequences over the next 8 to 10 years. Eventually, we will solve the problem, and we will solve the problem by having a system where we will only pay for things that are covered with income taxes. Now, what has to happen to get there? Well, in the 2016 election, we'll be knee-deep in this stuff. In the 2020 election, we're likely to be up to our eyeballs in it. And in the 2020 election, after people have lived a few years with 40 to 60% unemployment, with multi-100% inflation, with gold, I mean not gold, but with stocks, bonds, and real estate being in the toilet, they will recognize that we can't just keep printing money for entitlements. And at that point, they will elect congressmen and a president that will tackle the problem by putting in a monetary system where spending is limited to what we take in revenues. And from that point forward, we will have a fantastic future. Now, this isn't just the United States that's going through this. This is a worldwide event. The United States is the largest economy, of course, and we print the largest amount of money. China is the second largest economy, and China is printing a lot of money as well, although it's hard to tell exactly because they're not as public with their information. Japan is the third largest economy in the world, and under Abenomics, Japan is printing more money than the U.S. government as a percentage of their GDP. There are three groups of people. There are those who don't see the fiscal crisis coming and don't prepare for it. This is the largest group. There are those who hear about the fiscal crisis and don't do anything, like a deer in the headlights maybe. They're the second largest group. And then the happy monkey is those who hear about the fiscal crisis and prepare, and they're the smallest group. So the question is, which group are you in? Which group will you be in? Remember, the Chinese symbol for crisis consists of both danger and opportunity. Hopefully you will use some of the information that was gone through today as an opportunity for you to improve your position and how you're going to be affected when we go through this. And if you would like to make a free appointment, our first appointment is no charge. We're happy to go over any questions you have, look at your finances, your balance sheet, and make suggestions. If you want to go forward, then we could help you with a plan to avoid inflation, or we could help you develop a portfolio that would be expected to do better in inflation. If you'd like to receive our newsletter, you have given us your email and we will put you on the mailing list. If you don't want to get the newsletter anymore, you can unsubscribe. Thank you.